Bitcoin for 3 years and your max return is 45%, like, why would you do that? Like, that doesn't, to your point,
Exactly.
you're not putting in Bitcoin to be your stable, give me 8% a year type thing. It's like you're putting your money in Bitcoin for this thing to triple in 3 years or potentially be down 80%, right? Like
That's the whole point. Yeah. There's
yeah.
the latest trend, and most of the new offerings in the buffer space have been crypto related, either attached to Bitcoin or ETH.
Mhm.
And I am in full agreement with you. The first ones were like 0% downside, but like upside cap of like 10%, which was ridiculous. Now they've done what you're talking about, which is having a little bit of a longer period of time, but like your upside's capped at 20 or 30%, and your downside is capped at like 20. And my whole point is exactly what you just said. The reason you own Bitcoin is because of the asymmetrical return opportunity.
Yeah.
And also the knowledge and understanding that, it's volatile and you could be down 80% as much as you could be up 1,000%. But that has diversification benefits in a portfolio. And so you want that. That's a feature, not a bug. And so when you remove that, it feels a little bit disingenuous to have these products because the folks that are buying them would never really own Bitcoin because they're
I,
risk averse. So
I
they're
completely
buying
agree.
them to
Yeah.
say they own Bitcoin, but it's
I,
not really Bitcoin exposure.
I, I totally agree. Imagine having a venture capital portfolio where you cap your winners at 45% over 3 years. Like, that's insane.
Mhm.
The whole point of that business is to have, you know, 2 out of 100 that are 1,000x. So yeah, I completely agree with you that doesn't make a whole lot of sense.
Yeah. So now that we've established that some of these products, I like to say, because I'm not afraid to make waves, they're just well packaged marketing stories, and they
Mhm.
just don't make sense in my head. Some people are more aggressive about it. Cliff Asness has written many a white paper on his disdain for these buffer products, but ultimately, at the end of the day, a buffer ETF is a structured note in an ETF form, and you have to understand that, look through the prospectus, understand what the underlying are, how it's being priced, but also understand that the ETF's pricing and all the price movement between the issuance and the expiration of that buffer before it rolls is going to be market movements, and whatever the underlying is doing is going to be reflected in the price of the product and not necessarily the defined outcome that you purchased it for.